All right. I think or as the moderator of the first panel, I have decided that we have a quorum. So let's start. My name is Jacob Kierkegaard, and I'm a senior fellow here at the Peterson Institute for International Economics. And I'm standing in for our president, Adam Posen, who will be joining us for the second part of today's program. But since I'm first in line, let me start by welcoming everyone and welcoming the McKinsey Global Institute back to the Peterson Institute, and say that it is really, in my opinion, a particular pleasure for me and for us to welcome MGI back here for a number of reasons. First of all, of course, this week was once again a case where the Nobel Prize in economics was given to really empirical microeconomic work and its relevance for macro policy. So there is a trend there. So if MGI keeps it up, then maybe there are opportunities there in the future. But it's a very timely focus there. It's also a great pleasure for the Institute because today's focus, as you will have seen from the program invitation, is really very much about productivity and the opportunities that there are for productivity growth in Europe, which follows very well in line with an institute focus that we've had on productivity growth here. During 2015, we had Kathy Mann and her OECD team present on their views on productivity. Broadly speaking, over the summer, we had just last week a big report or a focus or conference on US productivity, and we'll have a big productivity project and conference also in November. So in that sense, today's presentation with the focus on European productivity is very much in line with our general research program here. And then finally, of course, I will say as a European expert, it's a pleasure to be up here and really present an optimistic story about Europe, and really a story that doesn't focus on who's going to leave next and why they're not going to leave after all, but rather really, as I said, a good news story which really, in my opinion, gives, and I should say in full honesty, someone who wrote a book about 10 years ago about transforming the European economy and really emphasized the opportunities for Europe for higher productivity growth through structural reforms and other issues. It's a pleasure to see that there are still serious researchers to take up this mantle. And in some ways, and as we will see later today, the report that MGI has made is really, in my opinion, a very bold one, both because it has a very optimistic outcome, 2 to 3% sustained growth rates in Europe, I think is certainly well beyond what most would call baseline scenarios. But more importantly, they go on to say that 75% of this improvement can be achieved within the existing institutional structure. And I certainly believe, while I don't disagree with that, because I think a lot of it is on the member state level, but I think that that is very different from the general narrative that we hear about what is needed in Europe. And so mostly it's a productivity story, and it's also, to some extent, more labor input. And I think it's very important that the report, as you will see, highlights the role of immigration. And I'm therefore also happy to say that on an optimistic note, having just read the headlines this week and in recent weeks, that part of the equation seems to be at least moving towards some degree of progress in Europe. But really, all of that will be dealt with in the actual program or report presentation, which starts at noon. But before that, we thought we would put together an exciting two-part program. So what we will start with here at the policy panel to begin with is really an in-depth look at three separate elements of what is the European conundrum, which is, of course, a very multifaceted crisis. So we have three exciting, in my opinion, presentations. We will hear from Bill Klein, who will talk about his path-breaking work on debt sustainability in the euro area more broadly, and of course also what to do about the Greek situation. We have Nicolas Veron, who will try to shift his focus from banking to capital markets union, while hopefully still being able to claim the intellectual leadership on that broader issue as well. And then finally, we have Jan Mischke from MGI, who will, I think it's fair to say, offer you a surprising take on monetary policy from someone living in a German-speaking part of Europe. But without further ado, what we will do is we will have each present everybody has a PowerPoint, so each will present from the podium, and then afterwards we will have a panel discussion with Q&A from the audience. So Bill, why don't you start? Oh, sorry. So before we do that, Jan, did you have? Oh, sorry.
Don't want to take much time before we get into really the interesting content here, but just it's a great pleasure and honor to also welcome this distinguished list of guests also on behalf of the McKinsey Global Institute. And this is in fact a very special moment and, if you will, location for us at this point, because we just yesterday had our 25th anniversary celebration, celebrating 25 years of independent research funded by the partners of McKinsey, for which I am very grateful. And the entire research actually started with a look at the productivity of Europe, or more specifically Germany at the time, in comparison to Japan and the US. So 25 years tradition in looking at productivity and the opportunities in productivity. But then in this piece of research that Eric Labai is going to present in more breadth and depth over lunch, also expanding much more into macroeconomic topics and into a lot of hidden controversial gems, I would say, like immigration, monetary policy, and other topics. So very warm welcome, and looking forward to the discussion.
Well, it's a pleasure to be here this morning with so many friends and experts, and to revisit where we stand on the debt crisis in the euro area, and in particular, the question of where the Greek debt burden and restructuring question stands. I will begin with an overview of the euro area for periphery economies excluding Greece, and then turn to the case of Greece. The broad picture is that, with the exception of Greece, the sovereign debt crisis of the euro area periphery has been brought under control. Sovereign spreads have consolidated their decline from the crisis levels of 2011 and 12. Even the highest spread at present for Portugal is down to 180 basis points, from a peak of nearly 1,500 basis points in 2012. Those for Spain and Italy in the range of 110 to 125 basis points, down from peaks of 550 basis points. In July of last year, the Institute published my book, Managing the Euro Area Debt Crisis. And in that study, I developed a probabilistic model for projecting the sovereign debt burden. It considered baseline, favorable, and unfavorable scenarios for 5 key variables: growth, sovereign spreads, primary fiscal surplus, privatization, bank recapitalization, and then it took account of the correlations between whether, if a particular variable was going to be in the unfavorable state, would the other variable likely be in its favorable state or its unfavorable state. That then provided a basis for getting a probability distribution of some 250 outcomes in the model. And when I did that, the projections I made, the probability-weighted projections for the debt to GDP ratios were, as you see here, they are on a path to converge to the range of 100 to 120% of GDP by 2020, with Ireland, Italy, and Portugal converging downward, and Spain converging upward to an intermediate plateau. With debt at about 120% or below, and this being the threshold that had been fairly early identified as one for a target for sustainability in the euro area crisis, the basic conclusion was that the crisis for these four economies had indeed been one of liquidity, temporary market shock, and not a problem of insolvency that required writing down the debt. The adjustment measures that were taken, and especially the ECB's financial bazooka, outright monetary transactions to purchase sovereign bonds if necessary, have made the problem manageable. In my book, I concluded the four periphery economies should be able to manage their debt successfully, do not need restructuring, but that Greece was a special case and might need further relief contingent on fiscal performance and structural reform. And to me, that conclusion still looks right. It's useful to compare the projections I made for the four periphery economies in the middle of last year with what the most recent outlook in the WEO and the other IMF country documents are. For growth, the most recent outlook is much better than I had predicted in Ireland and especially Spain. The fund's projection for Italy is slightly worse than my baseline, and Portugal has been showing the most disappointing trend, with the fund's five-year outlook averaging 0.4 percentage point lower than the average that I had used. The broader picture, however, is that the most recent growth projections are all consistent with gradual improvement in debt sustainability, especially in Ireland, averaging 3.5% growth in the next 5 years, in Spain, almost 2.5%, but also for Italy and Portugal, both averaging about 1.25% growth. For the ratio of gross debt to GDP, all four countries show an encouraging declining trend. Even Spain, where I had projected instead a rise to an intermediate plateau. Italy is the one case where the fund's projection is significantly higher than mine, but that divergence was already present in my analysis last year because I argued that Italy will do significant privatization, and the fund's projections do not include the effects of any privatization. Perhaps the most encouraging aspect of the recent fund projections is that the burden of interest is lower as a percent of GDP in all cases than I had in my baseline. In part, this seems to reflect the much lower interest environment. I note that if you look at the April 2014 wheel, the plateau for Italy is 5%, exactly what mine is. But in the October 2015 wheel, the plateau for Italy is 4% of GDP in interest. So the main thing that I think that it seems to have happened is the quantitative easing in euro area and lower interest expectations. The broad point, however, is that especially in the new picture, all four countries are on either a stable or a declining interest to GDP burden path. Let me then turn to the case of Greece. Now, in the first half of this year, the populist and confrontational policies of the new Syriza government destabilized the economy, climaxing the closure of the banks and referendum rejecting the terms of the financial rescue package offered by the euro area partners. But facing the alternative of a Brexit, in July, Mr. Tsipras agreed to a new support program with conditions at least as demanding as those rejected in the referendum. And the new agreement did raise the possibility of debt relief through longer maturities, but explicitly ruled out a haircut on debt principal. On August 14, 2015, the finance ministers agreed with Greece on a new support program for 86 billion euros. The IMF, however, indicated that it would only participate if the euro area grants Greece debt relief. Now, this chart shows spreads on 10-year bonds before and after the March 2012 exchange. After, they mean rather something quite different, but they still have some information. And they show the major stabilization of the situation that occurred by mid-2014. But then again, the return to crisis in the first half of 2015, and more recently, a renewed phase of improvement with spreads now about 700 basis points. In evaluating the new situation, it's important to recognize that the headline debt figure for Greece, now close to 200% of GDP, overstates the true burden of debt. This is a central fact about Greek debt. Most of Greek debt is owed to the official sector partners at concessional interest rates, and the interest burden is much lower than would usually be associated with the same gross debt. Now, under the fund's own criteria for sustainability in these circumstances, which has become the ratio of gross financing needs to GDP, I'll come back to what that involves, Greek debt should remain within an acceptable range at least through 2030. And in a sense, it's questionable, I would argue, to base a debt relief policy on problems that might or might not occur on such a distant horizon. Now, moreover, most of the projected sharp increase in debt that we're having right now for Greece could be avoided by carrying out bank recapitalization directly from the ESM to the banks, or perhaps to the Helvetic Financial Stability Fund in a standalone basis, rather than placing this debt on the books of Greece. After all, this debt creates an asset. So the optics of having it substantially increase the gross debt reported are unfortunate. Now, there's still an important role for using interest rate relief, I would argue, for two purposes. First, suppose that Greece experiences a growth shortfall, significant growth shortfall from the baseline due to circumstances that are not its problem. Let's say neighbor gets into trouble, markets get in trouble. Anyway, it's not a question of policy slippage. Well, rather than having to meet the same fiscal target by further fiscal tightening and therefore pro-cyclical response, it would make sense for the euro area partners to be ready to forgive some of the interest that would be due for that year as a means of interest relief that is conducive to Greece growing out of the problem. Now, second, Greek unemployment levels are at depression levels of 26%. So one could imagine that during a phase while unemployment remains so high, euro area partners might, out of solidarity, decide to earmark some portion of the interest due to them for special employment programs. So at the end of the day, one could imagine some role for debt relief. It's just not so obvious to me that it should be focused on rollover of principal, 15 or 20 years from now. Now, let me turn to some of the broader issues of the debt relief question for Greece. Now, some have said that it's only fair for the euro area to give debt relief, further debt relief, to Greece because the official loans that they piled up mainly went to finance the dash of euro area banks to get to safety as Greece imploded. It turns out that the amount of bank funds extracted were substantial, 70 billion, but that's only about 1/3 of the total official support. Now, critics also say that the Troika contributed to Greece's depression by calling for too much austerity. Now, the fiscal adjustment was large, no doubt about it. The cyclically adjusted primary fiscal balance swung from minus 13% of GDP in 2009 to plus 5% in 2014. That's twice the tightening in Portugal and Spain and Ireland. But Greece had no fiscal space to adjust more slowly. It was cut off from the financial markets. The official sector support was already stretched to the limit. Now, some might say the euro area support has been too stingy because it forced Greece to adjust too much, too fast. But support from partner countries amounted to 110% of Greek GDP. That's 3 to 4 times as much as provided to Ireland. And in comparison, in the United States episode, it was comparable, the Mexican peso crisis, we provided support that was only about 5% of Mexican GDP on a very short-term basis. The adjustment that was needed was large because spending had gotten totally out of control. Real primary spending had surged by 54% from 2000 to 2009, far more than Portugal, 22%, Italy, 16%. And primary spending relative to GDP had risen from 40% of GDP to 49%. Nor would less adjustment have paid for itself through induced revenue under higher growth. Even at the upper bound of the IMF's revised view of the multiplier under these circumstances, a 1.7 multiplier, smaller spending cuts would not have boosted GDP and revenue enough to pay for themselves. Much of the adjustment in this period, but in addition, and crucially, was in an environment of complete panic in the markets. And the announcement of less fiscal effort would have contributed to an upward spiraling of sovereign spreads beyond what occurred. As a final broad policy question, it is interesting to ask, well, does it make any sense to pile another 86 billion euros onto the debt of a country that's already over-indebted? That's 40% of GDP. The answer is that most of the new support will go to amortize existing debt, recapitalize banks, and thereby acquire assets, or pay arrears built up during the last year, and to build up deposits. So the rise in the net debt is only 10 to 15 billion euros. All these details, by the way, are in the policy brief that is handed out at the front. Now, in that brief, I updated my European debt simulation model for Greece. And I began with growth assumptions that had negative growth this year and next, and then 3% growth by 2017-18, easing to about 1.5%. The fund's October WEO has growth somewhat lower at first, somewhat higher later. This graph also shows what might have occurred in the absence of the political destabilization, the populist destabilization. The fund's projection last year had the growth at 3% in 2015-16. The other assumptions in my projections have the primary fiscal balance rising from 0 this year to 3.5% of GDP by 2019 and after. And I also assume that privatization will generate receipts on the order of 2/3 of a percentage point of GDP. And another key assumption not shown here is that there will be 25 billion euros in bank recapitalization needs, which adds about 12% of GDP to the debt ratio. Now, two classic debt burden indicators are shown in this figure. The debt reaches a peak of about 201% of GDP, but the interest burden is only 4.2% of GDP in 2015 to 20, and 4.4% in 21 to 24. The reason is that the debt owed to the EFSF and the ESM plays a low interest rate averaging 1.6% in the first period and 2.6% in the second. In comparison, The average interest burden for Portugal, 2015-20, is projected at 4.3%. Even though Portugal's debt is much lower, easing from 126% of GDP to 121% by 2020. So again, the debt, nominal debt ratio very substantially overstates the debt burden. Now, the IMF has recognized the interest burden for Greece is unusually low, given its gross debt. As a consequence, it has shifted to a different metric, which is the gross financing needs. Now, this is the finance you need to cover the fiscal deficit, but also the finance that you need to repay the maturities coming due on the debt that the government has. And as you look out at the end of these very long official loans from the euro area partners, at a certain point, the amortization kicks in. In part, based on past cross-country analysis, the fund says that a safe level for the gross financing needs is 15% of GDP for an emerging market country and 20% of GDP for an advanced economy. Well, it turns out that except for this initial bulge, or I will show you, except for an initial bulge in 2015 because of the bank recapitalization, gross financing needs are going to remain comfortably within that range for the foreseeable future, for at least the coming decade. Now, this figure shows my baseline for the debt to GDP ratio alongside the projections that the fund made in June before the referendum and bank freeze, and then the fund's most recent WEO projection. In addition, the NBR variant that is shown is for no bank recapitalization. If the 25 billion euros were somehow kept off the books of sovereign debt or ignored because it's creating an asset. And the figure strongly suggests that the optics of the Greek debt burden would be much improved if it could indeed do the bank recapitalization in a fashion that doesn't accrue directly to the sovereign. This figure shows the corresponding projections for the interest burden. And mine dovetail quite closely with the funds. But there's a variant that this includes, which is strictly to show scope for relief if one goes the relief route. The lower variant is what happens to the interest burden in a zero interest holiday for the next 10 years from the euro area partners. And that path, by 2024, cuts about 3% of GDP off of the debt servicing burden. Now, the broader point is that even with no interest relief, the low official rates already mean that the interest burden is within the 3.5% to 4.5% of GDP range, which by most international comparisons is manageable. Finally, if one focuses on the gross financing need instead of the debt ratio and the interest burden, it turns out that there's no particular problem for Greece over the next decade. The gross financing need does surge because of the bank recap, but then is under 15% through 2024. So it turns out one of the best kept secrets in Washington is that the IMF's insistence on debt relief for Greece is premised on a problem that doesn't arise until about 2030. Because under the fund's own projections, the gross financing needs do not exceed this threshold until then. I'm getting the high sign here, so what I will do is not go into detail about this notion of using some interest relief for counter-cyclical purposes or for unemployment. I would note that just by forgiving 1/4 of the interest due in a particular year, something like 135,000 jobs could be created in public works programs as illustrative of what one might do. The final consideration then is what the IMF should be doing in the next phase of this. I think the IMF should have a presence, but not a large or lending role. That's a very practical reason. Greece has to pay a penalty interest rate of 300 basis points above the normal lending rate from the fund because it has a huge amount of fund debt already, and it's got very long-term maturities. So it would be desirable for Greece to have as much of the financing of the 86 billion as possible come from the euro area partners and not from the fund. At the same time, fund monitoring would be desirable to help ensure proper policy design. So I would suggest some modest amount of support on the order of, say, $1 billion or euros might be the appropriate approach for the fund's participation. The overall conclusion, in my mind, is the euro area debt crisis has largely been controlled, that even the Greek debt burden is manageable in the base case over the next 15 years, especially as measured by the interest burden, but even measured by gross financing needs. Even so, the partners could usefully provide contingent relief on interest during some years if growth or shortfalls occur, and to help reduce unemployment. Thank you.
Thank you, Jacob. I'll shift to a slightly different set of issues, not focused on fiscal and sovereign debt, but more on the financial system itself and especially the structure of the European financial system. And my headline is Capital Markets Union, another acronym for the European Union, which heretofore will be summarized as CMU. So President of the European Commission, Jean-Claude Juncker, at the time President-elect, announced this project in July 2014, a bit more than a year ago. And I will try to give an update on what that means at this point, which in a way is a focus on a specific policy project, but in a larger way is a way to reflect on the structure of the European financial system and how it might contribute to growth, which I think is a relevant complement to the sort of things that the MGI report is addressing. Even so, the MGI report doesn't put a lot of emphasis on the financial system. I think thinking of finance as not just a stability issue, but also an issue for growth and the structural features of the European economy, including productivity, is relevant for us at this point. So the policy intent, as you see, is to improve the financing of the European economy and help reduce its very high dependence on bank funding. And I'll explain in a minute why this is a valuable and relevant policy objective. Even so, and after having read this quote, there is some uncertainty on the definition of capital markets union right now in the European Union. And it's a mix of a number of different objectives. One of them is classical, traditional internal market policy. And here there's nothing new. The financial market is part of the European internal market, as such covered by the European treaty since the Rome Treaty of 1957. And there have been a number of specific initiatives to integrate the financial system and the capital markets in the history of the European Union. So there was a report on creating a European capital markets called the Segre Report in 1966, Then the Single European Act of 1985 and the corresponding single market strategy was meant to lead to more integration in the financial system as such. And then there was a specific financial services action plan announced under the leadership of then Commissioner Mario Monti in 1999, which was very similar in intent to the current capital markets union. So in a way, it's old wine in a new bottle. Every 15 to 20 years, there is an iteration of this effort to integrate European finance. I think one thing that is notable about the current initiative, which I will present in more detail shortly, is that there is an emphasis not just on cross-border integration, but also on capital markets development, and the idea that European integration can give critical mass to capital market segments, can optimize investor access, and therefore shift the European system, as a Juncker quote suggested, away from bank dominance towards a more balanced situation between banks and capital markets, maybe some form of convergence with the US. I think an important aspect of the definition of capital markets union is that even so it rings like banking union, it's not banking union. And banking union, as many of you I'm sure are familiar, is this very radical decision 3 years ago to shift the emphasis of banking policy in the European Union, or at least in the Eurozone, from the national level to the European level. And a big part of this has been the empowerment of the European Central Bank, the ECB, as the supervisor of all banks in the euro area, with some delegation for the smaller ones. But banking union was, a crisis response. It was decided at a moment of massive uncertainty, which was well illustrated by Bill's slides on sovereign debt spreads. And actually, I believe, and there are strong reasons to believe, that the OMT, this bazooka of the ECB, was made possible by the decisions a few weeks before of the European political principles to start banking union. But banking union was focused on changes in the institutional framework. It was really about changing the turf of different authorities and moving the licensing authority from banks, crucially from the national authorities to the ECB. And it was also limited to the euro area, possibly Euro Plus if Denmark and other countries want to join. But the UK clearly not included, while the UK is clearly included in capital markets union. So I think it's really important to not think of capital markets union as the equivalent of banking union for capital markets. The name is a misnomer. So before I enter into the details of this policy initiative, let me set the scene with a few numbers about the European banking system. Europe is very bank heavy. Here is a slide comparing the US, the European Union, China, and Japan in terms of the general structure of the financial system, everything together, banking assets, corporate and government debt, and equity markets in green. And what you see is that banks are dominant in Europe, not as much as in China, but almost, and more than in Japan and, of course, in the United States. If you focus more specifically on corporate debt, the dominance of bank lending is even more pronounced. Here it's just bank loans and corporate debt securities, non-financial debt securities in a number of jurisdictions. And you see that the EU is as bank-dominated as China and Japan. And actually, if you look at the euro area, it's even more bank-dominated than China and Japan. So the European Union is really an extreme case of dominance of the financial system by banks, at least among developed economies. And interestingly, this dominance has increased, not decreased, in the last 15 years, even before the crisis and more so during the crisis, unlike what the trend was in the years before, around 1999-2000. This is from a very important paper by Sam Langfield and Marco Pagano, published by the ECB a couple of months ago, on what they call bank bias in Europe. And this shows that both in terms of level and in terms of trend, you have the situation which is really different from Japan and the US. One of the consequences of this is that the European banks are the superpowers, or the European Union is the hyperpower in terms of bank assets from a global perspective. I think this chart is very striking. This is bank assets as measured by the IMF in their IFS database. And comparing the European Union, the US, Japan, and China, and the rest of the world is a thin black line. As you see, the rest of the world is really not that big compared with those 4 jurisdictions. And of course, the dominant fact here is European Union is bigger by a mile than anybody else. China is growing very rapidly. We'll see how that trend continues or not after the recent developments in China. It's very spectacular here. The US is remarkably bank light. It's about the same as Japan, actually, in terms of total banking assets. And the European Union has had an extraordinary expansion of bank balance sheets in the years before the crisis and hasn't seen much deleveraging since, even so the expansion has been halted. So that's about the structures. I guess most of you are familiar with the basics of European financial policy, so this is a bit of a sort of primer for those of you that might not be familiar with it, but I think mostly repeating known things. The important thing to keep in mind is that legislation and rulemaking on finance in Europe is mostly at the European level, and specifically at the European Union level, decided on a qualified majority by the Council and with co-decision by the European Parliament. There is secondary rulemaking, not unlike US agency rulemaking, by the so-called European supervisory agencies, which was a big reform introduced in 2011. So there are 3 agencies for banking, insurance, and markets, the EBA, EIOPA, and ESMA. All the acronyms are explained in small print below. I'm sorry, this slide is extremely acronym heavy. This is done for all member states, including the UK. Of course, Switzerland, not part of the EU, is not part of this. And there are exceptions to this general EU leadership in rulemaking. For example, the Vickers reform in the UK, which was a sort of mild Glass-Steagall, ring fencing retail banking from banking holding companies, is a national initiative. Most of the bank or the consumer financial protection, as you would call it now in the US, is done at the national level. So there is a lot of rulemaking at the national level, but the big ticket items are generally European. By contrast, enforcement and supervision is mostly national, and I think this is really important to understand the political economy of capital markets in Europe. There are no fewer than 51 different agencies that are members of EBA, EIOPA, and ESMA. And there are actually other agencies, such as, for example, the UK Financial Reporting Council, which supervises auditors and actuaries and enforces accounting standards in the UK and equivalent in other countries, which are not even in that count. So really, there are a lot of different agencies involved in financial sector policy and regulation in Europe. There is and this doesn't count the federal agencies like the ones I mentioned, Single Resolution Board and all that. So examples in the UK, for example, are the Bank of England, the Prudential Regulation Authority, and the Financial Conduct Authority, which is a rough equivalent in the UK to the US SEC. The only exceptions are, as I mentioned, for euro area banks, very significant exception, now supervised by the European Central Bank, and having the Single Resolution Board, which is another new acronym, a new institution, a new organization that started in Brussels this year, which is a sort of embryonic European equivalent to the, or Eurozone equivalent to the FDIC. And the other exception, which is much smaller, is that credit rating agencies and derivative trade repositories are supervised by ESMA as an exception to the general rules that supervisors for market purposes are national. It's probably a good moment for me to disclose that I'm an independent board member of one of the big trade repositories, one of DTCC, and therefore this is an organization that is supervised by ESMA. So that was for setting the scene. Now let me focus on Capital Markets Union and first make the case for it before we look at what's actually in there in terms of recent announcements of the European Commission. So there are basically 3 reasons why Capital Markets Union is coming now and why there is a strong rationale for it: stability, growth, and politics. So let's look at them in that order. Rationale number 1 is stability. The idea being a mix of different things. The idea is that, banks are just too big. There's a too big to fail argument. Actually, it goes beyond too big to fail because the experience in the European Union in the last few years has been that no bank almost was allowed to fail, at least until 2012, no matter how small. And the very starting point of the crisis in Europe was the bailout of IKB in Germany in July 2007. So even before the securitization markets really began to freeze in early August, and that was not a very large bank. I think it was about 50 billion euro of total assets, which is not ridiculous, but not huge. So the moral hazard argument goes that if the banking system generally becomes smaller and banks become a smaller part of the overall system, it will be easier to have market discipline among banks and basically bail in creditors and the like, and avoid taxpayer bailout. There is a similar argument which was famously initiated by Alan Greenspan in 1999 in a comment about the Asian crisis, which is the so-called spare tire argument, which is to say if you have diversity in the system, if you don't have only banks, then you can react better to crisis. And I think it is actually the case that when Europe and the US were hit by a financial shock of similar magnitude in 2007, 2008, even though it originated in the US, Europe had so much exposure to US risk that it really was sort of a symmetrical shock. I think the spare tire argument worked very well in the case of the US. The banks could deleverage and restructure themselves reasonably quickly in 2008, 9, 10, while there was no general credit shortage in the economy because of the importance of capital markets. And conversely, in Europe, the deleveraging was much more difficult, maybe impossible, because there was no spare tire. And then there is a sort of slightly more sophisticated argument about risk sharing through markets channel, which goes back to a seminal paper by Asdrubali and co-authors about the US in 1996, which really gives more analytical substance to this by showing how shocks are absorbed. And I think, as I just said, if you look at the US and the EU after the initial shock of 2007, 2008, it's very illustrative. So here is a summary of that argument repackaged by the IMF in an important paper 2 years ago. You look at 3 channels to absorb asymmetrical shocks in different jurisdictions, fiscal insurance in green, capital markets channel in red, and the credit, basically banking channel, cross-border banking in yellow. And what you see here, of course, you can discuss the methodology, but the short point is that fiscal channels actually are a small part of the US ability to absorb this sort of shocks. So it's not mainly redistribution and fiscal mutualization. It's really the way capital markets are national and therefore make it possible that if you have, I don't know, a real estate downturn in Florida, you don't have the sort of transmission to the entire Floridan economy and deep recessions that you could see in EU cases. So the importance of integrated capital markets as a factor of stability cannot be underestimated. Second rationale is about growth and productivity, and here is where it connects most with the McKinsey Global Institute report. And the insight here is that non-bank finance is better suited for high-growth firms than bank finance. Banking finance in a way is a very traditional way of financing. Corporate growth takes collateral, a conservative outlook, and market finance can be better, or non-bank finance more generally, and also generate better opportunities for investors and generally optimize capital allocation. So there is, if you have more integrated capital markets, call it a capital markets union, the impact can be very important and positive for non-financial sectors. The impact on the financial sector itself is more ambiguous, and there is not necessarily uniformity across member states in terms of the positive impact, but this is a productivity and growth issue, not only a financial stability issue. And one way to illustrate it is to look at how companies grow in different parts of the world. So this is red-like population pyramids in classical, country demographics. And I look at the largest countries, largest listed companies as measured by the FT Global 500 rankings in 3 different parts of the world: Europe, the US, and emerging markets. And what you see here, this is unpublished results, but with a fairly robust methodology, is you look at when companies were born, Google, think of Google, General Electric, or Bank of America. They were born in different phases of US history. And you look at basically those big companies that are now in the largest in the world, when did they start? And what you see is that most of the European large companies started in the Victorian era, basically. By contrast, very few started recently, and this is different from the US, where you have Twin Peaks. You have a lot of companies starting in the Victorian era, but also many of them starting really recently, and that's not only in the technology sectors, it's also service innovators and the like. And in emerging markets, as you would expect, most companies are actually very young, and with this tremendous catch-up growth. So of course, this is not only about the financial system, but I think many people will agree with the propositions that the financial system is a big part of that, and the availability of market finance to finance high-paced and risky growth is important. The third rationale, never to be neglected when we talk about Europe, of course, or other parts of the world, is politics. So there's a part which is European politics, a part which is UK politics. So European politics is just that Juncker has this nice growth policy package, looking nice, at least in principle. There's a cyclical part, which is the investment plan, and there is a structural part, which is capital markets union, energy union, digital single market. I'm not entering into the detail of the other initiatives. But there is also a very important aspect with the UK, which is to have a positive agenda in the context of the referendum forthcoming next year or in 2017, and what Chancellor Osborne calls the remorseless logic of political integration in the euro area, which tends to create a disconnect between the UK and the rest of the EU, and Juncker, understandably, is preoccupied with countering this disconnect. So he appointed a British commissioner, Jonathan Hill, to oversee financial services, and there's a very UK-centric communication about capital markets union by the European Commission. Actually, if you look at the sound bites, whether they come from David Cameron, from the City of London, from UK think tanks, it's all warm and fuzzy. Capital markets union is seen as a very positive thing, showing UK influence, showing the European Union converging towards the UK, or with a slightly more detached view from an academic, Georg Ringe, who's actually in Germany, or in Denmark, actually. The CMU really framed as a sort of PR project for the UK, aimed at keeping the UK on board. And I think that is important also to understand the recent announcement. So there are of course, also political obstacles. There are concerns about sovereignty on supervision and enforcement, which I mentioned are mostly national. And this is not only the UK, it's perhaps most acute in the UK, but these obstacles exist in all member states. There are vested interests as usual. Local market infrastructure firms don't like the idea of competition. Also, parts of the banking industry don't like competition from capital markets. That's normal. Other parts of the banking industry actually like it because they're in those market segments. And there is also ideological resistance. There's a mild version of this in a paper recently published by FEPS, which is a think tank of the center-left in the European Parliament, saying, well, the crisis was a crisis of market-based banking, which is highly debatable, but that's the view from that part of the political field, and therefore it's really bizarre to promote market development in that context. So what's the current status? I'm coming to the announcements themselves. We had the initial announcement by Juncker in July 2014. We had a green paper, which is a sort of strategic intent, in February, and we had an action plan 2 weeks ago in late September. What's in there in the action plan? Actually, not much. There is a decision to incentivize insurers through twists in capital regulations to invest in infrastructure projects. There's an intent to revive securitization in Europe with some new regulations that will make it simpler and better treated in terms of capital ratios. Still a work in progress. There will be some simplification in IPO disclosures for small firms like the Jobs Act in the US. And the rest is basically announcing future reports, reviews, strategic oversight. So not many decisions at this point, and many challenges are still open in issues that you would consider very important for capital markets integration, including how to regulate market making in banks and the European equivalent to the Volcker rule, which is the so-called banking structural reform, which is still being examined in the European Parliament and Council. taxation of financial investment and trading, a number of ongoing projects like the financial transaction tax in some euro area member states, and the implementation of the OECD so-called BEPS, base erosion and profit shifting project, might actually create big obstacles to capital markets development and integration in the EU, so there is an issue of consistency. And then there are many issues which are really important for capital markets and on which the action plan of the European Commission doesn't say anything or almost anything, like accounting and auditing, financial market infrastructure, credit information frameworks, pension and housing finance frameworks, which arguably go well beyond financial regulation, and of course systemic risk oversight to make sure that shadow banks and the like don't disrupt the system. And even perhaps looming over all this is a question of institutions. I mentioned it in the context of banking union. The distinct willingness of the European Commission not to touch the overall balance that I presented at the outset, where regulation is European, but enforcement and supervision is national. And you can question whether that is compatible with the vision of an integrated marketplace. Actually, when you have fragmented regulatory enforcement, it does prevent market integration because regulators, national authorities don't trust each other, they defend their national champions, and basically they don't comply with legislations that promotes passporting or mutual recognition. They create obstacles, they create what the jargon calls gold plating, and therefore you don't have a single market. It's not unique in finance. Actually, this challenge exists for all regulated services and creates a lot of skepticism, I think. The fact that the European Commission, for perfectly understandable political reasons, doesn't want to touch the institutional framework at this point creates a lot of skepticism. So what's the outlook? And this is my last slide, Jacob. There is a change of tone, and that's, I think, very welcome. So ideas that financial policy is about growth, not just stability, that financial policy can be part of a structural reform agenda, has been articulated, I think, very powerfully by Commissioner Hill and the European Commission, and that's important. Also, the idea that markets can be a good thing, not just a bad thing, which is perhaps obvious in the US, apart from some corners of the political spectrum, but not obvious at all in countries like the one I'm from, France, which is very anti-market in its outlook in many ways. So there's this conversation ongoing, and I think it's important and may have long-term implications. So policy development on capital markets union is extremely incremental, almost insubstantial, very slow, and that illustrates the point that structural reform is difficult, not only at the level of individual member states, but also at the European level. And there is this particular UK constraint, which means that the issue of institutions, my previous slide, is really not going to be touched in any way, even small ways, until the UK referendum, because that would be immediately portrayed as a Brussels power grab in the UK debate, and therefore reinforce the camp of Eurosceptics. I think most importantly, in terms of the short and medium-term business outlook, is that most change that will happen in the European financial system will be driven by post-crisis bank deleveraging rather than the policy to integrate capital markets. And to the extent that there would be capital markets development, it will be market-driven and not policy-driven because of this deleveraging of banks. So in a way, banking union, at least in the short and medium term, and I guess in the long term as well as things currently look, is more impactful in terms of the structure of the European financial system going forward than capital markets union. And I'll stop there. Thank you very much.
So it's actually very rare these days to see some optimistic views on Europe and even more so on Greece. So I'm particularly grateful for your remarks here, and which we very much share also on a broader European scale. Now, rather than presenting the results of our deep research, which Eric Labai will do later today over lunch, I would like to take the opportunity of this panel, where we also have some room for discussion and discussion also with everyone in this room, to raise a couple of provocative questions more on the macro side of the European economy that came up more on the fringes of our research. I'm actually quite looking forward to the discussion that may follow. So starting point is a very simple and well-known one. There is an output gap and an aggregate demand gap in Europe. There are some discussions on how big it is. I think the latest estimates are around 2.8% of GDP, and of course discussions on whether that needs to be dealt with and how. But if you look at it on a per country level, so you can't see some of the colors very well, but kind of Greece, about 11% of GDP, Spain, around 6% of GDP, and even more so if you have a look at what it actually means as a gap to pre-crisis trend growth. Greece currently stands at half of what it would have been weren't it for a certain disruption. Spain 25% below, and we've seen or heard also some of the unemployment figures. So there is certainly an issue still in terms of demand in Europe. That is not only an economic problem. It looks like abstract numbers, but what does it mean if I just kind of do a very non-scientific cross-tab of that with a research that we did on across 16,000 Europeans, which included also questions of how happy are you with your country and similar. Then on many of those questions, I'm just highlighting one here, you actually find that countries like Spain and Italy, which are suffering quite strongly on that dimension and also having high unemployment, people are extremely unhappy with their country, which is not very surprising, but also not very surprisingly leads to much more fundamental political and societal challenges. So just looking at the share of votes for Eurosceptic parties here in the 2014 EU election, but we've also seen the results of the Greece elections more recently. Portugal was a little bit of an exception, almost to the positive side of reconfirming the austerity and reform path of the current party. But there's kind of still some political risks, I would say, below the surface of our generally optimistic view on Europe. Now, what is the traditional response to that? If you have an aggregate demand gap, well, you take fiscal policy and fiscal stimulus, and you take monetary policy and stimulus. That of course, we know from textbooks. What has Europe done? And been criticized for it quite a fair bit. If you look at the fiscal impulse, 2 phases since the crisis, right after the crisis, and then a little bit later when the recovery started, at least on this side of the Atlantic, not yet in Europe. See the US about a 9 percentage point fiscal stimulus over the first 3 years, mostly discretionary spending increases and tax reductions, with a quite substantial fiscal multiplier based on IMF estimates. During a downturn, those fiscal multipliers are much higher, giving like 20% of additional growth over that period against an obviously always undefined baseline, but buffering away quite a bit of the shock. In the Eurozone, only roughly half the stimulus, and almost all of that actually based on automatic stabilizers rather than discretionary stimulus, so it's kind of only stimulated as much as people couldn't avoid. And not very surprisingly, a deeper fall in GDP over that period. And what's worse, in 2011, actually in Europe, the recovery hadn't really started yet. So the fiscal contraction, which wasn't as severe in that period, about 4% of GDP, had a fairly high fiscal multiplier on the downside because it happened during the contraction. Whereas the actually much more severe fiscal contraction in the US of 7% of GDP happened in the upswing and had a lower fiscal multiplier. So fiscal policy is certainly explaining quite a bit of the difference in growth between Europe and the US. So have European policymakers been out of their minds or what they have been thinking? Well, I guess probably there are some people who know what economics look like also in Europe, but if you're in a situation where actually fiscal stimulus requires countries taking on guarantees and debt of each other, that's not something you would usually do without having a say on policy, without being confident that there's fiscal discipline, without seeing a primary fiscal surplus. So people rather went the way of the fiscal compact and so on to lay the ground for those things, which meant, during the crisis, very limited fiscal expansion. Is it good or bad? It is what it is. On the monetary side, I won't go through all those details, but if you look at the typical things that central banks would do and did, like acting as lender of last resorts, lowering the funds rates, QE and liquidity provisions, stress test, bank capitalization, and so on, that you always see the dark blue versus the light blue is Europe versus US. Europe did pretty much similar things, just usually 1 to 2 years later than the US. Again, much of that due to institutional difficulties and actually progressing faster and building the consensus for some of the institutional changes that were needed. But also in terms of much of the criticism why the ECB didn't act earlier in terms of resorting to QE, which have been voiced a lot, one can start raising quite a few questions. If you look at the transmission channels of QE into the economy and compare between the US and Europe, it's a very different picture, and there's no way to suggest that copy-paste approaches would work. Like the liquidity support for lending, it was probably better done via long-term refinancing operations in Europe than QE, but certainly there's an element here similar. But then you have the wealth effects, so QE pushing up asset prices, people feeling richer and spending more. Now, the European structure of household wealth is one where essentially only a very small strata of the population own equity and bonds and other capital market instruments. So the people affected by the wealth effect are exactly those with a close to zero marginal propensity to consume. It's more than questionable to see any or to expect any effects here. You have the corporate interest rate effect. Companies borrow more if the interest rate is lower. Well, the reality is that both sides of the Atlantic and all the interviews that we do with companies as a firm, of course, it's the same picture no matter whom we talk to. We invest when our IRR is 15% or 10% or 20%, depending on the industry. Companies have not adjusted their hurdle rates in reaction to interest rate changes. They have not, and they have not started investing. Then you have households and their mortgage rates, where again there's significant savings, of course, on mortgage interest payments that households can then spend on consumption, an effect that probably has happened in the US. I think there are still some discussions around that. But if you look at the European situation, where usually mortgages are fixed term for 20 to 30 years, you don't have that effect. And to make matters worse, when households, as we saw in Nicola's presentation, have actually most of their assets on bank accounts on interest rate payments, they actually have less interest income and more and the same mortgage or interest expenses. So this is probably even a negative effect on households in Europe. Currency effect, devaluation of the euro, probably, well, it did seem to happen and it did seem to work, so that's a major effect. And the most important one, probably both sides of the Atlantic, is also, again, what William was showing earlier, actually pushing the interest rates of or interest expense of governments down and actually channeling back some of those interest payments from the profits of the central banks to governments so that they can spend even more. So it's kind of some of a hidden fiscal expansion that has been happening here, which is questionable, of course, in terms of the institutional framework for the European Central Bank, but it's happening. So it did probably work to some extent, but a lot of question marks whether QE has been and is the right approach in Europe. So if fiscal policy is difficult and QE is difficult, what then? And this is where I want to raise some questions and see some reactions. The first proposition is raise taxes, increase taxes. What do we mean by that? If you look at the wealth distribution of households in Europe, about 70% of wealth is concentrated among 20% of the population. That's not an unusual picture. I think it's even 85% in the US and higher still in some emerging economies, so it's broadly a similar picture or even a relatively benign picture in Europe in terms of the wealth distribution. But people who actually have the assets have a marginal propensity to consume of each incremental dollar or euro that they have of only 13%. People who don't have a lot of money, like the bottom 20, 40, 60%, have a marginal propensity to consume of about 50 to 60 cents on the euro. If you now assume that you can't expand the fiscal deficits for all the institutional and mutual guarantee and moral hazard issues and so on that I laid out earlier, but you still want to have a form of fiscal stimulus, then you actually have to balance it. You need to kind of give more buying power in what form soever, be it via reductions in tax rates on low-income earners, to those people who actually spend and compensate that where the fiscal multiplier is lowest, which would be on elements like property taxation, capital gains taxation, broadening the tax base on capital gains and so on, elements that are actually considered economically efficient since the times of Adam Smith, and which can kind of, if you run the numbers and assume that these kind of propensities to consume are correct, one percentage point of redistribution from the top 20% to the bottom 50% would be sufficient to close the entire demand gap in Europe. 1%. It is a highly controversial thing, of course. It's redistributive. It has many consequences beyond economics, and probably people like the ones sitting in this room would be affected on the negative side. But thinking about it, giving 1% for actually stopping being a threat year on year and month on month, whether the next crisis will hit, seems like a potentially attractive deal. The other element that you could do on the monetary side is dropping money by the helicopter. And that's, of course, it's a long or old idea. The idea is not to do it, of course, in physical terms, but the ECB, in fact, crediting households directly with vouchers that they can spend or with money. It would need to go directly because the ECB is not allowed to finance governments, so it would need to go directly to households. That's obviously a very absurd idea by many standards, but if you compare it to QE, demand stimulus, well, very direct. Many of the people getting the money would actually spend it. That we know from surveys. Distributional consequences, QE, pushing up the asset prices of few, having low effects on others, all the different tricks that have been tried in Europe to make it at least non-distributive between countries and so on. We go for helicopter money, every household, same amount of money. The balance sheet of the central bank, QE currently expected at 1.6 trillion, and now estimate about 500 billion would be sufficient on helicopter money to solve the aggregate demand issue once and for all. Financial stability, jury is still out whether, when, and how European insurance industry, which is roughly as heavy as the banking industry, but often forgotten, will go belly up because they can't pay their pension obligations anymore in the current interest rate environment. If you go for helicopter money again, you can actually stabilize interests at more normal levels and you avoid that issue. But the obvious question, will it be acceptable by the political scene and by the public? So I raise that as a question also to everyone here. If it's accepted in this room, maybe it finds broader acceptance also in other spheres. Thank you.
Well, if I can start by inviting my fellow or other panelists to come to the table. And then let me say that as the panel chair, I have clearly failed in my task of time management, since we are now left with less than half an hour for Q&A. So therefore, let me immediately penalize myself and remove the questions that I had for all the panelists and go straight to the audience, because we really do have three very important and three distinct issues that we can talk about. So I don't want to take time dictating where we start or where we end, but rather open it up immediately to the audience. We have a microphone in the back. We have a wandering mic up here. And please, the floor is open, and we have about half an hour. But in the event that there are no questions from the audience, several here. There is a mic coming there. And please state your name and...
Yes. My name is Mario Baldassari from the University of Rome, and some time ago from the Italian Senate. My question to Bill Klein is, you compare different phases of debt-GDP ratio for, countries like Spain, Italy, Portugal, and Greece, and so on. But there is a missing point, not in your presentation. There is a missing point in the debate, which is the relative size of debt in Europe. which is what we miss is the total debt to GDP ratio in Europe, while you have the total debt GDP ratio in the US. So if you consider the relative size, you see that the Greek crisis is 2% of GDP in Europe. Maybe the Italian crisis would be a major one, but all the other crises are just small crises, like could be in North Dakota or whatever. So the real missing point is we miss the United States of Europe in some sense, in terms of financial aggregate and so on. And the other question to the three of you is that, in some way, you dealt with the effect of the crisis. I would wish to ask a question to you, but everybody else, about the causes of the crisis. And I'm working on a paper now, so that's why I raised the question. Trying to do some kind of simulation, as you did for forecasting what's going on in the next 4 or 5 years in terms of debt GDP in different countries. I did the other way around, and I did some kind of counterfactual simulation from 2003 to 2014, and I did simulate what I believe are the two big mistakes in European economic policy. First, the super euro, benign neglect, accepting the euro over-evaluated, and now we see, luckily enough, we had Olivier Blanchard at IMF and Mario Draghi in the European Central Bank, both classmates of mine at MIT many years ago, so the situation has changed. But if we would have some kind of parity between euro and dollar, and please don't tell me that the exchange rate is made every day by the markets. It's obvious. It's made every day by the market on the basis of monetary policies. So if the European Central Bank raises interest rates while the Federal Reserve decreases interest rates, it's quite obvious and trivial that you have an appreciation in the currency. In that case, European growth over this 12 years would be 12% higher GDP at the end of 2014 and around 80 million more jobs. So this is what we granted to the area of the world only by accepting this over-evaluation of the euro. And the other mistake is the Maastricht Treaty, because everybody was pushed to adjust deficit and debt without considering how. And the adjustment in any national country in Europe has been by increasing current account government expenditure, increasing taxes, and cutting down investments. So what we got out of this policy, out of this policy, zero growth, risk of deflation, and whenever you have zero growth and risk of deflation, how can you recover from a debt GDP crisis so high if the GDP in nominal terms some years is below zero? So please let me comment about the causes rather than the effects. Thank you.
Thank you. Well, maybe Bill, if you want to start with a question directly addressed to you, and then whoever wants to chime in on the causes of the crisis and the relative importance of them. Although I will say that there are certainly a number of people here at the Institute who'd be horrified by what you said about the exchange rate, but leaving that aside. Bill.
Well, I think it's certainly the case that Greece has always been a very small part of the total financial picture in the Eurozone. The high stakes were always in this crisis, whether Italy and Spain were going to go down the tubes. And at 600 basis points, it got a little too close to comfort, I would submit. The question, if you're dealing with a small Greece, a small Portugal, becomes, what is the right blend between solidarity to sort of, support, forgive, et cetera, and expecting the country to sort of, pull up its boots by itself, or with support to do its own homework. I would simply observe that the Eurozone gave more than 100% of Greek GDP in financial support, so it's not clear that they were too stingy. On your other points, I don't think it makes a lot of sense to say that the euro area should be running a current account surplus above 3% of GDP, which is where it would be if they had followed your recommendation to have a parity with the dollar and have this extra B, I'm skeptical of the growth equation, which has pure and simple the level of the real effective exchange rate on the right-hand side, with all due respect to Hans Werner Sinn. So I wouldn't say it'd be quite that easy. You'd get that much growth by having a more devalued exchange rate. And as of the causes, my sense of the cause of the metastasization of the debt crisis in the euro area was a total shift in paradigm. Until 2010, advanced countries had a zero sovereign risk. There had not been sovereign defaults by these countries since the 1930s. And when it became clear with Greece that was no longer the state of the affairs, you had just a radical shift in the perceived risk that meant that maybe Italy could go down the tubes. So the financial crisis started in the U.S., caused destabilization, but the total shift in the risk of sovereign debt default caused a new second phase that was crucial in Europe.
Anybody else on that?
Yeah, briefly. You may have seen one of my charts with this aggregate assets of the European banks, and you have this extraordinarily rapid pace of balance sheet growth until the crisis, and I think that comes as close as possible to a visual illustration of the causes of the crisis. In other terms, I don't think it's at all about monetary policy. It's really about the financial interaction between banks and sovereigns, essentially the bank sovereign feedback loop, which has, in my view, been the engine of the crisis and very much in line with what Bill just said about sovereign risk. But in the run-up to the crisis, a general lack of financial discipline, which was a combination of supervisory failures, financial repression, some sovereigns borrowing way too easily compared to their fundamentals. So basically a misalignment of incentives, particularly in the Eurozone, in terms of the general financial system, including both the sovereigns and the banks. And I think this is the cause of the crisis.
Jan?
Maybe if I can just briefly add a few thoughts. I think you mentioned the Maastricht Treaty here, which obviously everyone agrees is not necessarily a perfect treaty, but much has been said about it actually constraining the fiscal flexibility when the crisis was hardest. I would argue that view is wrong. What constrained the fiscal flexibility at the height of the crisis in those economies that needed it was financial markets, not the 3% threshold that was essentially not being held up anymore anyway. And the key deficiency that I would see in the Maastricht Treaty was actually not to spell out more clearly procedures for sovereign default that would have led to exactly the discipline that did not happen, as Nicholas was pointing it out. On the euro parity, Europe has been running a current account surplus pretty much as long as the euro exists and has expanded that current account surplus and trade surplus very substantially since the crisis as the only source of demand-side growth in Europe since the crisis. All domestic sources have gone down. So expanding that even further, I would be very careful about.
Dave Stockton, the Peterson Institute. I wanted to ask Jan a couple of questions about his helicopter drop proposal. One, is this a serious proposal on your part? Two, does the ECB actually have the authority to create these kind of accounts that you were describing? And then three, don't you need some kind of political guidance from democratically elected officials? Because no matter how these accounts were implemented, there would be important distributional consequences, and it would seem like you wouldn't want to be leaving those decisions to a central bank.
Yeah, so I'm obviously well aware of many of the complexities, and that's why I would say it's a semi-serious proposal. But it's still a kind of serious in the sense that in the discussions that we had, there were quite a number of people who would consider that it's well within the scope of the ECB mandate, because the mandate is to keep inflation below but close to 2%, which is currently very much failing on. So this would be one way to get inflation up to the target rate. It is challenged mostly on the grounds of this being a hidden fiscal policy, which is a fair criticism, but to be seen how the courts would rule. Very, very different views that we had in the many discussions on where the jury would fall here. And the distribution consequences are obviously real, but I would argue they are still lower than many other forms of monetary policy that are being taken, like QE. The form of supervision that you would need is, of course, also one of the main voice criticisms in terms of, okay, if you take one drip out of that bottle, the genie is out of the bottle and you can never rein it in, and every policymaker will just want to have more financing and helicopter drops for the central banks. But policymakers wouldn't have access to it. It would essentially be the central bank who could only resort to such measures if it is in a deflationary environment like now. That would be kind of the only way it could do that under the current institutional mandate. And actually, we did have also, of course, discussions with central bank heads. And some of them actually kind of privately said, well, we can't advocate for that for all the reasons you know, but please, if you and others prepare the ground, maybe we can talk about better policies than QE in future.
Rudy Penner from the Urban Institute. Question for Bill Klein. The huge improvement in the Greek fiscal situation, which you documented, was only possible with some extraordinarily harsh policies at the micro level. I'm thinking of huge cuts, arbitrary cuts sometimes, and an admittedly generous pension systems, changes in the safety net, employment and wages for civil servants, and so on. So wouldn't you be worried about some backsliding despite the best efforts of outsiders to contain it?
I think it's important to put those cuts into context. If you take real primary spending per capita and you put Portugal and Greece together on a chart, you're going to see they start out the 2000s pretty much together. Then Greece goes way, way up. Portugal sort of muddles along, comes up a little bit. And then they sort of come back, and Greece is still above Portugal. So the point is that they had this huge party. And I don't think the severity of the adjustment, there must have been a recognition that there was a huge party and that it couldn't last. So I wouldn't think it has quite the same implication. Let me also observe that the way a lot of people try to turn this is to say, well, you can't possibly have a 3.5% of GDP primary surplus, right? Not politically sustainable. I think that it is. Paulo Moro has here at the Institute has shown historical data on this, but it is also true that my projections for Greece are not radically sensitive to this. If you have a ceiling of 2.5% for the primary surplus, then by 2024, the interest payment as a percent of GDP is 5% of GDP instead of 4.7. Well, Italy has 5% right now. So I don't see, okay, yes, there was political fabric ripped, and we saw the explosion that had to happen to let out the renting or the venting of the emotions of that in the first half of this year, with a rejection of the adjustment package. And then I think that Mr. Tsipras basically became much more realistic and recognizes that the best way for Greece to have progress going forward is to stick to some of these. So, yes, difficult, but I think it's important to consider, A, that it was from a point of excess, and B, I do think it is feasible going forward.
Fred Bergston from the Institute. A quick comment on something Bill just said. He said that certainly the Greeks realized the party was going on. Well, why was the party going on? Because the markets set the Greek interest rate at the German level, as pointed out in the charts, and going all the way back before the crisis. So the markets provided this hugely erroneous signal to the Greek population, government, and everybody else. Now, you can say they should have been wise and foreseeing and should have known that even that was wrong, but that was a very powerful response to market forces that Greeks, both public and private, borrowed extensively, went into debt, figured they could continue to finance it at those low interest rates. And so all that is the one place where I think all of us need to have some sympathy for Greece, having been misled to a huge degree getting into their crisis by what went on at the market level, not by any bad policies by either them or by the EU officials. But I had a question for Nicola. Suppose you got your capital market union. How would that affect the international status of the euro? When we look at criteria for international currencies and compare dollar, euro, increasing RMB, key variable, obviously, is strength of financial markets. And even though the Eurozone is as big, or the EU as a whole is as big or almost as big as the dollar zone in the U.S. in GDP terms, it's always been concluded that the strong superiority of the U.S. capital markets still give the dollar a leg up, even abstracting from Europe's recent crisis and short-term problems. So would the creation of capital market union, when and if it eventuates along the lines you described, would that be a game changer in terms of the international role of the euro? And footnote, would it be a complicating factor that, as you said, the CMU would include the UK and non-euro members, whereas the currency we're talking about is the euro? How would that wrinkle affect any judgment on my basic question?
Nicholas?
Yeah, actually a comment on your initial point, which was on Greece borrowed on the basis of market signals. I think it's even worse than the way you portray it, because it's not just the markets who misread the policy. It was the policy that was fundamentally ambiguous and unsettled. Many people have forgotten this episode. In early 2009, there was a specific French-German initiative which was publicized by then German Finance Minister Per Steinbrück to define a stance of what would happen if one of the member states of the Eurozone would have a problem, as some Central and Eastern European member states were having at the time, like Hungary, Romania, not to mention Iceland. And the stance that was agreed, February 2009, was that fellow Eurozone countries would come to the rescue so that the market perceptions that Eurozone countries don't fail would be defended. And Per Steinbrück was cited sending that signal, not that explicitly, in the media. And I know from good source, and actually people who participate in those discussions are pretty open about them now, that this was an agreed explicit stance between France and Germany. So basically, at that point, it was not a market failure. It was a policy implicitly, and in that case, almost explicitly, that supported the low yields and low spreads. Now, that policy was not firmly anchored, and a year later, it was very different because of a number of factors, German change of coalition, dissatisfaction about moral hazard in Germany more generally, and a number of other things, including the lower level of general systemic uncertainty, ironically, in early 2010 compared with early 2009. But I think it's important to remember that the low spreads were based on a fundamental ambiguity of the policy framework. This ambiguity we know now was not constructive, but it did direct the market. Now, on your question about international role of the euro and capital markets union, obviously it's a complex question. I guess one thing that you probably have in mind when asking the question, and that is a relevant benchmark, is China. And it's clear that the international role of the renminbi is hobbled by the lack of dynamic capital markets in China. And I think that as long as the regime puts party discipline above market discipline, if you want to put it that way, that will remain the case. So that remains a fundamental limitation for the international role of the renminbi, as has been analyzed by many people. Now, the European situation is somewhere between China and the US in terms of international use of the currency and in terms of this power of the marketplace. And I think, frankly, the UK question, as you hinted at at the end of your question, is a big part of that. As long as we don't know whether the EU capital markets corresponds to a currency area or to several currency areas, which in practice is really two currency areas because it's basically sterling and euro. The rest is marginal and is likely to be subsumed into euro at some point. Sorry, Jacob, in terms of Denmark. It's difficult to know. And as I try to highlight in my presentation, the specific situation of the UK is one of the biggest obstacles, arguably the biggest obstacle, that will prevent the capital markets union from meriting its name. So I think the referendum is historically important. I hope it will lead to the UK staying in the European Union, but I think there are a number of follow-up questions on the relationship between the UK and the European Union and what that means for the European integration project, including in terms of global influence, that will certainly be discussed if, again, as I hope, the UK chooses to stay in.
Very, very brief. I just want to push back on Fred's, the market made me do it for Greece. You know, there was this little problem of misrepresenting the size of the debt and the size of the fiscal deficits. I don't think that quite fits that. A. B, the market did pay a price. More than 100 billion of euro debt took a hit of at least 50%, 60% in net present value when they did the exchange in 2012. So, you know, they got their comeuppance. But my most important point on this is I don't think we want to validate the perception that for the next 50 years, advanced countries are likely to go into default and go down the tubes. I think it would be better if we could work back toward the perception that advanced countries don't do that. That chart that I showed, the very first spread chart, shows we've made a lot of progress in the euro area, and it's important to isolate Greece as an exception to the rule. That's why I would push back again from my fellow panelist here who thinks that the big thing missing in Maastricht was a cookbook for how you go bankrupt when you're a government in the Eurozone. That's the last thing that they need.
Ann Krieger, SAIS. 2 points, both on Greece but different. First, to Fred Bergston's and Bill's comment on who did it and how. It seems to me that it doesn't matter what the interest rate is as long as it's positive. It makes no sense over time to talk about countries that have fiscal deficits of 15% of GDP. Nobody says that because the interest rate is 1%, you have to do that regardless of what your structural balance is and so on and so forth. So I find it hard to say the markets made them do it in that sense. The second point is a little bit more technical to Jan, and that is he calculated the output gap for Greece based on the growth from 2002 to 2009. Now, unless I misremember, Bill Klein said that during that period, real growth of government expenditure was 54%. Am I correct? Do I remember the number? I think that's about it. Anyway, be that as it may, taking the 5 or 6 or 7 years prior to a crisis as the period over which you're going to talk about what the sustainable rate of growth was, when it clearly was not, strikes me as overestimated. I agree there was an output gap, no doubt about that, but that estimate of it seems to be is somewhat biased.
Jan, do you want to comment on that?
Yeah, I essentially agree. That's kind of what we use in our calculations is the output gap as estimated by European Commission, IMF, OECD, and so on. The kind of gap to pre-crisis trend is just an illustration to show the order of magnitude of what has happened since the crisis, but it's not the basis for calculations.
Can I come in on him? I want to come in on some of the points that Mr. Mishkin made. I was fascinated by his survey results that the firms don't budge their hurdle rate. And I think that this is quite important because it says that fiscal or that quantitative easing mainly works through maybe consumer durables, but not so much through investments. That's a very important thing. On the other hand, I'm very skeptical that you want to use fiscal restructuring and redistribution as a, anti-cyclical, tool. And if you set up a structural tax on wealth, that doesn't strike me as the kind of thing you want to sort of tweak depending on whether this year the business cycle is weak. I mean, I thought that the literature in this area was that the fiscal changes of that nature are too slow moving, and by the time you get them, they're not a great anti-cyclical device. But just a couple of observations.
Yeah, I mean, I think that's certainly a very fair push. Kind of first, maybe on the hurdle rate. So it's something that I find striking, and coming from so many interviews of CEOs and so on. So it's not a representative survey in that sense, but it is actually consistent with the numbers that we see. Corporate investment has not picked up. Interest rates have now been at historic lows for a long time. Corporates are hoarding cash and not investing. And also kind of research that we show kind of corporate investment almost always follows the recovery. It almost never leads. So there's I think a lot of questions still to be raised about some of the traditional economic orthodoxies on monetary policy in that regard. So I wouldn't say that I have all the answers, but there's a couple of questions to be raised. On the redistributive kind of taxation, so is that kind of my suggestion on how an ideal fiscal response to a crisis would look like? God forbid, for sure not. But given the complexities in Europe, where the Eurozone essentially failed to respond on the fiscal side, not for a cyclical year, but now for 8 consecutive years and still facing an aggregate demand gap, then I would say, well, 8 years might be enough to start exploring some of those things.
Thank you. Martin Wijsels, European Central Bank. Wanted to react to Mr. Mishka's presentation. I wanted to make three points. First, I think your assessment of the ECB's QE is premature. Basically, this policy has just been started to implement. We're basically 1/3 the way until September 16. Maybe there's need to go further. The Governing Council has indicated that it is open to discuss the parameters of the program, but it's far too early to make the assessment that you're making in our view. We do see actually clear effects. We see a portfolio rebalancing effect. We see that the policy has had an impact on confidence. We see actually an improvement of lending conditions, which is actually a bit inconsistent with what you're saying on the hurdle rates of companies, because we do see in our bank lending surveys that credit and lending conditions are improving. So our assessment is not in line with yours there. Second point, I think this is a feeling that's been is a feeling that is a dominant feeling in the Governing Council, is that monetary policy cannot do everything. You're basically asking more from monetary policy, whereas I think monetary policy has already done a lot to raise growth. And I think you also have to consider here what really the factors are that are limiting growth, especially in the more medium term. And the view of the Governing Council is that other policies should also support their fiscal structural policies, in particular to raise the growth potential. Third point on helicopter money. I wonder if you really kind of thought about the implications of what you're proposing, because this is really going far beyond anything that has been done so far. You're essentially proposing to transfer fiscal policy to the central bank, and this is a major change that goes, as I said, goes beyond anything that has been considered so far. Thank you.
Thank you very much for those remarks or questions or comments. So, what I would so I'm actually looking forward also to the assessments of what will happen in QE, and kind of my impression based on a very different angle, which is again interviews with companies, is indeed that QE is working via some channels. So it does create a much better spirit, and it is probably next to cheap oil, which is probably a much bigger effect, still one of the key drivers why Europe currently is, kind of the European economy currently is much stronger than it used to be. So looking forward to the more rigorous assessment here. What I was more thinking kind of, almost kind of a question back, if you compare, say, quantitative easing to something like helicopter money, which kind of also going back to your question, it is not a proposal for something that should be done tomorrow. I think it's far too premature, too many questions, too many complexities. You're pointing to the right things here. But it is kind of a proposal to put this topic into a more broad and mainstream debate from a complete crazy idea on the fringes that is currently happening. And from that perspective, kind of the question back, is it a topic that is even being discussed in the ECB or in kind of other circles that you kind of interact in?
We may have time for one more brief question, if it is to be found in the audience. That is not the case, as far as I can see. Well, then I will declare this first part of today's program over. I'd like to thank the panelists for very substantive presentations and the audience. Lunch is now served, so please go and help yourself. Come back for what will be, I think it's fair to say, despite the quality of the panel, the main part of the today's program, where we will have Eric Labbé present the actual content of the new MGI report, followed by the Peterson Institute stage debut, at least as a staff, by Olivia Blanchard. Thank you very much.